Well, whether you are an e-commerce seller or trading in another type of business, the business that you initially set up will affect your responsibilities and your tax requirements. There are three main types of businesses that you could open. You've got a sole trader, you've got an LTD, which is a limited liability company, and you've also got an LLP, which is a limited liability partnership. If you're a startup business, a sole trader might seem like the best course of action. However, as you grow, establishing a company would become more beneficial from a tax perspective. Now, to give you an idea as to what each company might entail. First of all, a sole trader. So, a sole trader is a self-employed person who owns and runs a business as an individual. A sole trader only has to do a self-assessment to file each year, which means there's less reporting requirements involved than incorporated business. As a sole trader, there is no distinctions between your personal assets and business assets. As a result, this means that there might be a risk placed on the individual, which is not so good. That being said, if you do make a loss, you are able to offset your trading losses as a sole trader against other income apart from capital gains. This is going to make it a lot more favourable as a startup business. The pitfalls, however, with being a sole trader are that you can't do any tax planning. The income made within the tax year will be taxed, so it cannot look for tax benefits to save money. Also, as a sole trader, you are liable to pay Class 2 and potentially even Class 4 national insurance. This would be something to consider. Also, if you are an e-commerce seller, it can potentially be hard to switch from a sole trader to a registered company down the line, especially if you are trading on Amazon. Now, to discuss an LTD. An LTD is usually the most common option to open. It's a legal entity that's registered on Companies House. By law, you only need to have a minimum of one director and at least one shareholder. These two don't have to be the same people or bodies. You will have to file statutory accounts and corporation tax returns with Companies House and HMRC retrospectively, and you're also required to do this annually. Whilst there are many tax benefits to being an LTD, the main one is that corporation tax is 19% at the present, and it is required to be paid on all profits that are made, which would be lower than the income tax that you would pay if you are a sole trader, which can vary from 20% to 45%. You could also be potentially liable for Class 1 national insurance on top of this, but this can be potentially avoidable upon comprehensive tax planning. You can also tax plan to look for additional tax savings. Furthermore, you can have flexibility as to whether you declare your personal income as delayed dividends, which is going to be a benefit. The downside, however, is that the reporting requirements are more onerous than a sole trader. Also, any changes that you make to a company do need to be declared to Companies House, and this will make it an administrative burden. Finally, an LLP. Now, this isn't as common, but what an LLP is registered on Companies House as well, and it must have 2 or more members to exist. An LLP requires a partnership return to be made along with a self-assessment. In a normal partnership relationship, liability is unlimited, whereas in an LLP, the liability is limited to the capital that each partner contributes to the partnership. There is no corporation tax that needs to be paid for an LLP. However, you do have to pay income tax, and this has to be paid to whichever country you reside in. Therefore, it could potentially be seen favourable to non-UK residents, depending on the country that you reside in. However, I would recommend you seek professional tax advice in order to know more about this.